we have to see where the markets are trending for the year, for the next 2 years, or even for the medium term after the budget. That's the question we will be posing to our market master for the day, Nilesh Shah of Kotak Mahindra Asset Management Company. It's a little difficult to put that two together. Nilesh, we'll get used to it by and by. Thank you very much for joining us. Well, what's the sense? Is the pre-budget rally over?
I don't think so. We can say that pre-budget rally is over. I think we will see a phase in the market where it will build on the platform which it has already done in the last 1 year. There is a lot of expectations about the budget and the earnings, and clearly the result trends which we have seen, some results have met expectations, some have disappointed, and which is why market is kind of pausing in between to build a base for the next rally. I think the sustenance of this will depend a lot on what happens in the budget and how do we see the earnings recovery happening over next coming quarters.
Nilesh, hi, good morning. Good to see you in. What is the expectation as far as asset allocation is concerned? What is your view on whether equity funds will do better than debt funds? Which ones will give better returns by the end of the year?
So the good part is that both the funds will do very well in this year. The bad part is that they won't do as well as they had done in last 1 year. But clearly in the equity space, we believe if you have about 3-year horizon and you can come in on an SIP basis rather than one go, that should produce good return over next 3 years. On the fixed income side, clearly this is the time to build upon duration. And while policy rates will continue to decline, the markets will try to sometimes outrun that. And which is why both in the fixed income fund as well as in the equity fund, you will have good returns for the next coming year. In the fixed income fund, I will recommend you to load duration at one go rather than doing an SIP. In equity funds, I will recommend to do SIP rather than investing at one go.
So, okay, just to follow up to that, when you say low duration at one go, what would that mean? And also, would you advise it to, short-term debt funds like 3-month funds, or do you think a longer-term debt funds would be more lucrative?
So, as long as you have more than 3 months horizon, my recommendation will be to put your money today into Kotak Gilt Fund and Kotak Bond Fund. I mean, don't wait for tomorrow. Today is the time to invest into duration.
Okay. How much are you factoring in by way of rate cuts? Where do you see the 10-year? What kind of gains in a year in, say, typically 10-year investments, 10-year bond investments?
So, before the credit policy, the market's expectation was about 100 plus basis point reduction in policy rates. I think post yesterday's credit policy, we think we will be probably looking at around 75 to 100 basis point policy rate reduction in this financial year.
Okay. Well, Nilesh, what do you think realistically the market can return this year itself? The 3-year story is, yes, is what is on everyone's lips. By the end of the BJP's tenure, a lot will be delivered. But for people looking for, some conviction shorter term, do you think in this year the market can still return, say, 20%?
Lata, it's always very difficult to predict what will happen in next 12 months. When clearly we have to recognize that markets are no longer cheap as they were in mid-2013. The valuation levels have moved from 12-13 times to 17-18 times. The earnings growth is little bit delayed compared to the market's expectation. And clearly right now, lack of supply has also supported the prices. Now with Coal India and HDFC Bank supply coming to the market, some of that appetite will be met, and that will create some moderation into prices. And anyway, investing in equity with 12-month horizon will not be appropriate at today's fair value market. So my recommendation is that don't look at 12 months. Here is a great opportunity to capture longer term benefit while the amount of SIP into equity mutual funds and retail participation into stock market is increased. it has miles to go before it can reach to some sanity level in terms of asset allocation. So don't look at what's going to happen in next 12 months. Just do SIP into equity funds with a 3-year, 5-year horizon, and then evaluate your portfolio at the end of 3rd or 5th year rather than what happens in the intervening period.
Okay. So you just mentioned in debt funds to invest into gilt and the bond fund today. So in equity funds, what are the recommendations, the ones that investors should invest into? And should we look at diversified funds itself, or should investors, now go in for some of the thematic funds, some of the sectors that are doing well?
For the beginners and for the people who have average risk profile, I will recommend that to come into diversified funds, maybe large cap funds like Kotak Select Focus, or a blend of large and mid cap funds. Clearly at this point of time, mid caps are almost valued at par with large cap, and hence if you are investing in mid cap, do invest only via SIP. So our recommendation will be to go towards diversified fund, large cap, blend of large and mid cap. And if you want to invest in mid cap for higher risk and higher return, then do take a longer term view. The thematic funds are more meant for informed investors who have their own view and opinion on the market, and certainly they can participate in thematic funds like infrastructure funds, technology fund, pharmaceutical funds, banking funds. But this is more meant for informed investors, not for the beginners or average risk profile guys.
Fair point, Nilesh. Well, since you're such a keen observer of the markets, what's your sense about banking stocks? I mean, their leadership is needed for the Nifty, but do you think that they may not deliver, at least in the near term, over the next quarter or so?
So within the banking space now, we have to actually divide things in 3 components. One is the public sector banks, the second is the private sector banks, and the third is the non-banking finance company. If you see in this component, the non-banking finance companies haven't done as well for a variety of reasons. And as the bulk deposit rates, bulk borrowing rate starts coming down, probably NBFC sector, partly because of the underperformance of last 1 year and partly because of this drop in borrowing cost, should be able to outperform the market over next 12 to 18 months. In the public sector banks, the biggest worry which people have is today in terms of what is the extent of NPA and how will they be capitalized to leverage on growth. Our credit growth numbers have fallen to probably lowest in last decade, and that's partly driven by what's happening in the economy, and it's also partly driven by the lack of adequate capital in the public sector undertaking in the PSU banks. So recapitalization of PSU banks and the treatment of NPA will be a far bigger factor driving PSU banks, and as of today there seems to be a little bit of doubts in the minds of market about on both those factors. So at best within PSU banks you will have some stocks doing well, but on a broad basis I think the PSU banks will continue to underperform the market. That leaves you with the private sector banks, and we have seen in terms of market's appetite for capital in private sector banks, we have also seen their administration and management and running of the private sector banks being far superior to PSU bank, and which is why natural capital allocation will happen towards private sector banks. So I think the private sector banks and NBFCs will continue to lead outperformance of banking sector into the market.
Okay. You did start off your conversation by saying that the bad part about investing now is that the returns may not be as high as what we got in 2014. But even if we don't get a 30% return, what kind of returns are you expecting by the end of 2015 and 2016? What could the cumulative rise be?
So it's very difficult to predict 1 year return in equity funds. But my guess is that this year probably, one, partly because inflation has come down and partly because markets are poised well for fixed income as well as equity, we should be able to deliver real rate of return to investors. We should be able to deliver reasonably good rate of return to investors in equity funds and fixed income funds compared to, say, any other products, be it currency funds, be it commodity funds, be it probably even investment in real estate. So on an average, we can guarantee that there will be real rate of return, and we can reasonably confidently say that the outperformance of fixed income funds and equity funds over real estate, commodity and currency will be reasonably good for investors.
Okay. Well, one question, as someone who has been watching the fund scene for so long, has retail investor appetite returned? What are the numbers now in Jan, and what's your forecast? You think it's picking on a secular basis?
I think the retail investors this time has become very, very smart. They started investing into the market around, the bottom of the market. The trend actually bottomed out and started moving up. We have seen their participation through mutual funds. We have seen their participation through direct investments into the market. Clearly, some of the catalysts were IPOs like Power Grid Corporation and Central PSU ETF. Then the change in the government obviously created positive sentiment. And today, the best part is that a lot of retail money is flowing through a systematic investment plan. And in this financial year, I wouldn't be surprised if the total SIP collection will be between 25 to 30,000 crore. So not only retail money is participating into the market, it is participating in a smart way. Now the only prayer which I will have for retail investor is that don't try to time the market. Please put your time into the market. You have entered correctly. Now stay correctly so that you can have positive experience on your portfolios.
All right, Nilesh. Thanks for that advice. I'm sure a lot of people are listening, and 25 to 30,000 crores, that's a lot of money expected into this market. Thanks for joining us and giving us your views.